Thank you for taking the time to join us this evening for an Endowus webinar titled Securing Passive Income in Uncertain Times. My name is Sean, Head of Investments at Endowus. I'm delighted to be joined by our friends from Goldman Sachs Asset Management and Manulife Investment Management. We have two speakers this evening, David Copsey, Executive Director from the Multi-Asset Solutions Group at GSAM, and Alvin Ong, Managing Director and Head of Fixed Income at Manulife IM. Thank you, David and Alvin, for taking the time. Now, if I could ask the speakers to provide a brief introduction of themselves and their coverage. Maybe Alvin, I'll start with you.
Sure, thanks, Sean, and thank you everybody for taking the time to attend this webinar. Alvin Ong, I head the fixed income team in Singapore, managing mainly Singapore-based assets in Asian dollar and Sing dollar bonds.
To David.
Great, thanks, Sean. Nice to speak to you all. Thanks for taking the time to be with us this evening. So my name is David Copsey. I'm a portfolio manager within the multi-asset solutions team within Goldman Sachs Asset Management. I focus on managing our funds, which is a very broad scope where we can invest globally across all asset classes in delivering a various range of different outcomes, including income.
Great, thank you both. In terms of this evening's agenda, I'll cover a brief overview of Endowus. Then we'll jump into a primer of how investors should think about income investing. I'll ask Alvin and David to again provide a brief reintroduction of their firms as well. I think people in the industry know them very well, but it's obviously worth highlighting for those of you not so familiar with Manulife and GSAM. Then we'll jump right into the meat of things with kind of a broad market overview from both Alvin and David and what they're seeing in terms of where we've come from in the markets, where they think we're going, expectations for the second half of the year. Then we'll jump into opportunities and risks for an income investor, what they're really seeing on the ground, being on the portfolio management team on the front line, looking for opportunities and avoiding risks as active managers. And if there's additional time at the end, obviously we'll collate Q&A. We'll be running a Slido as per the usual. So do ask us any questions at any time. Okay, so just going through disclaimers. Okay, Endowus. Endowus was born with the mission to help investors invest better, to live better. We do this by providing advice, access to top-tier managers. Obviously, two partner firms are speaking today. And we offer this at a very low and fair fee. And we're completely transparent about this as well. At Endowus, we're a holistic digital wealth platform. We provide top-tier manager access. We're holistic as well. So investors look at us for CPF investing, but increasingly, obviously, a lot of our assets are cash denominated where investors are looking to invest their cash assets for a longer term. What we've grown the platform over time. So obviously we offer money market fund offerings. These are very topical today. Money market fund yields are, Sing dollars, 3.5% to 4%, US dollars, probably around 5%. Equity funds providing efficient market access. Recently, we have a lot of interest in top tier hedge funds. We have access to those as well. Private equity, private credit solutions too. We're focused a lot on financial literacy. We provide a host of insight and research content on how individuals should think about markets and investing. And as a listener on this call, again, I'd like to thank you for taking the time. So do obviously go on to our website, take a look at our platform and listen to any of the insights that we share. Finally, Slido. So we're running a Q&A. So if you have any questions at any time on income investing, do ask us. So go to Slido, type in income 2023 and post your questions there. I see there's a whole host of questions already coming in. Okay, and with that, I'll turn it over to David first. You could kind of tell us a bit about GSAM for those of us who are not so familiar.
Great, thanks, Sean. So Goldman Sachs Asset Management is part of the broader Goldman Sachs group. We're the investment management division that's responsible for investing client capital. So we're one of the largest investment managers in the world. We manage over 2 trillion of total assets around the world. In terms of scale, so we do cover pretty much every major asset class. There's around 2,000 professionals based in around 31 offices across the world. And our culture really is one of delivering excellent and consistent investment performance to our clients. I sit within what's called the multi-asset solutions team. So we have the ability to really invest across the full gamut of different asset classes and make use of all of those underlying security selection expertise from the whole of Goldman Sachs Asset Management. We've been together as a multi-asset solutions team for around 25 years. We manage over $250 billion in assets. And my focus really has been on delivering our institutional capabilities to investors, both through our funds and broader retail and high net worth solutions.
Fantastic. Thank you, David. And Alvin, to you on Manulife Investment Management.
Yeah, so our parent company, Manulife Financial, we manage close to $1 trillion, placing us in the top 5 globally. We are a leading Canada-based financial services provider, established more than 100 years ago. We operate as John Hancock in the US and Manulife in other regions. To the next slide. Yep. So I'm from Manulife Investment Management. We are basically the asset management arm for our parent company. We have a big global footprint, spread across 19 different locations, managing around $755 billion. We have one of the largest Asian fixed income presence within the region, with more than 200 investment professionals spread across 10 different markets in Asia. Turning to the next slide. We basically provide wide-ranging investment capabilities, across public, private markets, and multi-asset solutions for our clients. And maybe the next slide. So we really have a strong brand reputation, when it comes to fixed income, particularly in Asia and Singapore. And here are some of the awards that we have achieved for our Asian fixed income and single fixed income strategies.
Thank you again. Delighted to be working with such strong partners offering kind of best-in-class funds across many different asset classes to our clients. Okay, so now I'll just take a quick couple minutes to just talk about a primer for income investing, which will set the stage for kind of what will go on for the rest of this call. Okay, so this is how we think about income investing at Endowus. Income investing is a strategy that aims at generating steady stream of income, and this can stem from various sources. If we look across asset classes, here are some examples of where investors can derive their income from. Within fixed income, we typically think about these as coupons. Bonds pay coupons. They're based on credit risk, geographic risk, and duration risk. So you can see some examples there. Obviously, investment grade bonds. Corporate bonds will pay a higher yield than, say, treasury bonds, and high yield bonds, as you move down the credit structure, will pay a little bit more coupons and commensurate levels of risk as well. Within equities, I think a lot of us as single stock investors are very familiar with the concept of dividend payments, so I won't spend too much time there. And finally, some managers also utilize alternative sources to derive income. We can think of derivative solutions. Some managers sell covered calls to generate additional stream of income. Some people park REITs and real estate investments here as well. Why does an investor invest for income? There's a couple of reasons for this. Firstly, some are looking to supplement their monthly income that they get from their salaries. They could meet financial obligations, such as a mortgage, a monthly mortgage. That's, people are required to pay. A lot of Singaporeans have these, assets in their houses that they have to pay every month, or even some of people accrue income to pay for an upcoming holiday. Secondly, it's really income investing is to build up a war chest for a rainy day, for example, a job loss or, something, an unexpected liquidity need comes up. And so, if you've accrued income over time, you can obviously use this war chest that you build up to supplement that. Finally, income investment, if done correctly, can strengthen your portfolio. Income assets, certain types of income assets have low correlations to traditional asset classes or, kind of broad market beta. And so that's also interesting for certain types of investors. Okay, so on this slide here, it just talks about details regarding the pros and cons of some sources of income investing. I won't go through all the details here. If you look at on the left of the page, single stocks and bond investing, right? The first 3 columns, these are a familiar concept to many investors. You receive regular dividends or semi-annual coupon payments, depending if you're investing in stocks or equity. These tend to have single issuer concentration risk and volatility associated with such directional investments. So they tend to be a little bit more risky, but obviously some of the companies are easier to understand. Income funds on the right tend to be more diversified in nature, but we do have to be careful in selecting managers with a proven track record that deliver a consistent stream of income. They have a very clear investment objective. And obviously, in active management, there are fees associated with these. So we need to make sure the manager is actually generating income or returns in excess of these fees. And obviously, we want to make sure that they're charging a fairly low fee on that. Okay, so that's the very quick primer on income investing. And with that, I'll turn it over to our speakers. I can just talk about this since it's on as well. So what makes a good passive income investment strategy? We hope that income investing has the potential for long-term capital appreciation, particularly if you tilt towards equities, right? So obviously, income and an ongoing stream of returns, if we think about fixed income, that's primarily for ongoing income streams. And then when you tilt towards equities, you will obviously have a longer term potential for capital appreciation with commensurate levels of risk. And obviously you should have a longer term time horizon for this. We hope that income investing will overcome inflation risk. I think this is one of the risks that a lot of investors parking assets in money market funds today need to consider very critically, because it's interesting. It's good to see 3-4% yields where 19 months ago we really didn't have any yields within money market fund instruments, but inflation has run fairly high. We know that it's come back down. I'm sure our speakers will address this as well. So it's something that we should think about, perhaps taking on a little more risk to overcome inflation. They need to be well diversified. So again, I mentioned this earlier, we really think about diversification as one of the key tenets of investing. So you really want to think about diversifying your asset class mix to the extent possible. And part of it is a tilt towards income. Okay, I think I've spoken enough. So really, I'll turn it over to David. From your lens, you look at the global footprint, right? Multi-asset everywhere around the world. So can you kind of walk us through from your lens where markets have come from, year to date? What is your outlook for the markets, and where do you think we're kind of going to for the rest of the year?
Yeah, of course. And we've called this section late cycle, not end of cycle. And that is a very short one sentence summary is our outlook as we see it at the moment. And so what I'll do with the next few pages is just walk you through what leads us to draw that conclusion and how we're thinking about that macro inflation growth backdrop. So on this page, what we're showing is what's been an extraordinary rally this year. So some of the worst fears of investors coming into the year just haven't come through. Many fearing a collapse of growth, perhaps also an earnings recession driven by extraordinary high cost input prices, and you just haven't seen that coming through. Broadly speaking, growth has remained positive, especially in the US. Just had the Q2 numbers out, which remained above about 2.5%. Consumers have remained strong. So through COVID, one of the big impacts on the consumer was that lots of people saved a much bigger proportion of their salaries. And what you're now seeing is as people come out of lockdown and start to think about consuming again, you're seeing a very big impulse of some of that pent up savings coming through. What we see on the left-hand side here is the equity market. So broad equity markets are up between 15 and 25% if you look at Europe and Japan. Most of that has been driven not by an increase in earnings, but really improvements in people's sentiment towards equity. So the so-called price to earnings ratio, so how much people are willing to pay for those earnings, has improved this year. And we think that's in part driven by people's concerns around some of the worst case recessionary fears, if not being removed, being at least pushed out into probably next year. On the right-hand side, what we're looking at here is markets' views of central bank action. So what we're looking at is we've got two different lines. So the purple line looks at the expectations of where the US Federal Reserve interest rate policy rate will be going out for the next year or so. And we look at that where it was at the end of May. So you can see markets expected that policy rate as we go out over to the end of the year to have been brought down. So suggesting that the Fed was expected to start to cut rates in the second half of this year by up to 1%. What you've seen recently is you've seen people's expectations of these cuts being moved out. So now there are essentially no cuts being expected this year. and then central banks now being expected to cut rates into next year. And we think that's one of the big drivers in markets at the moment, that people are accepting that inflation is likely stickier than many had thought. And that means that central bank rates are likely going to remain slightly higher for longer as central banks seek to combat that inflationary backdrop that we're seeing. Moving to the next page, just to put this in context. So last year is a year that many people will want to forget, those that had investments in markets. And what we're showing on the left-hand side is just what a rare occurrence what we saw last year was. And what we're showing on this 2x2 grid was only around 2% of the time in history do you have a calendar year where you have negative returns on bonds and equities. So that's the bottom left-hand quadrant of that. And last year we saw not only negative returns to bonds and equities, driven by that increase in expectations around inflation and central banks exiting very loose monetary policy. That meant that bonds and equities fell at the same time. But the magnitude of those losses were also very big. They were especially big in bond markets. And what you can see on the right-hand side is, as a result of that, valuations do look less stretched now, we think, than they were at the end of 2021. So what we've shown on the right-hand chart is we've plotted the how expensive each one of these different asset classes was relative to its own history going back to 2005. So the purple dot shows that, for example, interest rates in the US were in the 99th percentile. That means since 2005, they were only more expensive 1% of the time. And given you've seen central banks rising rates, you've seen that coming all the way down up until recently, only coming down to 22, the 22nd percentile. It's not as dramatic on the equity side. The rally that you've seen this year has meant that equity markets have come off the being at their very all-time highs, but you've seen a lot of dispersion. So you have seen, for example, very strong rally in US tech this year. You've seen expectations around AI and generative AI technologies driving very strong earnings on the technology sector. That does mean that within the index, there's some extremes. So broadly, the US equity market makes up 70% of the MSCI world. The index is trading around 19 times earnings. But when you strip that out and think about removing those mega cap names, it's actually only trading around 15 times earnings, which more is aligned to its long-term average. So that valuation picture, the overall doesn't look extraordinarily cheap, but to us, it also doesn't necessarily look extraordinarily expensive. You can be selective about which stocks and which sectors you're investing in. To dive a bit more deeply into the growth outlook. So the summary here is that, as we said, we think the economy is likely late cycle, not end of cycle. We think that, as we show here, what the black bars are reflecting the consensus view from economists as taken by Bloomberg for growth for the rest of this year. What you can see is that global growth is expected to be just a little bit below long-term trend. The Eurozone is expected to underperform relative to the US in economic growth terms. And then relative to a weak 2022, Chinese growth is expected to rebound, notwithstanding the fact that some of that early stage opening momentum that we were seeing in Chinese growth has started to fade. We do think that some of the policy action that's coming through from the PBOC and the Chinese government is likely to support growth in the second half of the year. But the challenge with that growth picture, whilst it's lower than the long-term average, we don't think it's going to be a collapsing growth. As we said, we don't think that the consumer is particularly vulnerable, given they've got that war chest of savings pent up. Equally, if you look at corporations and their sentiment, as we've shown on the right-hand side, what you've seen is this big bifurcation in the services sector against the manufacturing sector. So manufacturing has weakened very, very significantly. That's the chart on the bottom. What is looking at surveys of manufacturers. On the top half of the chart, we've got the services sector. Here, people have gone back to consuming. They've gone back to experiences over buying things that was much more in favor of buying physical goods during COVID. People are traveling again. People are going out to restaurants. And that means that there's a very strong demand for services, and yet manufacturing physical goods are severely lagging relative to that service part of the economy. And so whilst overall growth's okay, the real drivers of growth have shifted from manufacturing really to services, and that's created some challenges for central banks as they think about fighting inflation. And so on the topic of inflation on the next slide, what we're showing here on the left-hand side is US inflation data. And as you can see from going back to its peak in June in 2022, inflation has been trending lower. What we've really been seeing as driving some of that reduction in headline inflation has been that energy component, which has been pulling down the overall headline level. The trouble is that core inflation, so core inflation is the part of inflation which strips out some of the more cyclical elements to look at what something of more of a sticky, measurable read on inflation. That remains very strong still. It's core inflation remains around 4% in the US, so nearly 1% above headline inflation. And so the reason for that really is that you're seeing certain elements that are more sticky. So house prices have remained quite high. They have shown signs of coming off, and that's making central bank jobs that little bit easier. The part of the economy really that has not rebalanced is the labour market. And that's been, I think, one thing that surprised a number of people is just how strong that labour market's been. What we're showing on the right-hand side is, and to give you a stat, this is looking at something the job openings to unemployment stat. So what this black line is showing is how many jobs were there for every single person in the US that was looking for employment. And so at its peak, there was around 5 million jobs in the US. That meant that at its peak there was around 2 jobs available for every one person looking for employment. And the challenge that's put on central banks is that's kept wages very high. So people are be able to demand a high salary, and that's the part of the economy that now the central banks are really trying to bring back under control to avoid a wage price spiral. And that's why, as we showed on the prior chart, we think that higher rates for the time being are here to stay as central banks try to cool down the labour market and dampen down wages, which have been running well north of 4 to 5% in many regions. On the next page, thinking about monetary policy, so we went into the COVID crisis, many central banks reduced rates to 0 or below 0 at the same time. So you saw this unified reaction to the potential collapse in growth and activity. What you're now seeing is a differentiated path out of that ultra loose monetary policy, where on the left-hand side, you still have some regions like the Eurozone, like the UK, that are still struggling to get inflation under control, versus some of those early hikers, so those markets which hiked to fight inflation earlier, many of those in emerging markets that are now actually on a loosening cycle. So countries like Uruguay, Hungary, Vietnam have already begun easing cycles. And as this chart shows, a number of market participants expecting a broader range of emerging markets to continue to, over the next 12 months, to cut rates, which could signal, at least in emerging markets near term, that we've reached a peak in rates. And in developed markets, we think that we are nearing the end of the cycle of further rate hikes, for example, in the US, and maybe just a couple of rate hikes left in places like the Eurozone and other regions. So this sets the stage for less uncertainty around the future path. And we think in this environment, you can still continue to see markets performing quite well, notwithstanding the fact that we do think as we go into next year, that push and pull and the tipping point and the big question that markets and companies still need to answer is, will that savings rate come down? Will you continue to see companies being able to pass on inflation and input costs to consumers? Or will the impact of higher rates, of higher mortgages, which are now back at some of the most expensive financing rates they've been since the global financial crisis, will that hit the consumer too quickly before inflation gets back under control? And will that lead to a compression of margins? And if we look historically, central banks haven't got a great track record of being able to raise rates and get inflation under control without triggering a recession. And so far, some of the signs are looking reasonably positive, but there, in our view, is still a real risk as we go into next year that could tip to the negative side. So investors need to prepare for that eventuality.
Thank you, David, for those comments. Yeah, so I'll turn it now to Alvin. Really, what are you seeing? You have a lot more regional lens specifically. You focus a lot on Sing dollar bonds and regional opportunities and risks as well. So really, what is the outlook you have over for Asia?
Sure. I mean, just a quick recap. I mean, last year was really a challenging year for financial markets. We saw most asset classes, being impacted. This year so far has also been a pretty bumpy ride. Given the aggressive rate hikes, that has added stress into the financial system. I think in March we saw bank runs in the US, the collapse of CS in Europe, and recent macro and inflation prints in the US has moderated, which has kind of allowed the Fed to assess the pace of its tightening cycle. We think we are much closer to a potential pause compared to where we were a year ago. In China, while the reopening since last November has lost some momentum, that's it. The government has been introducing fiscal and monetary policy measures to try to stimulate the economy. And elsewhere in Asia, most Asian central banks are also at the end of its tightening cycle. With most countries also enjoying benign inflation. Overall, we believe Asia should be a primary beneficiary of this stabilizing macro environment, as its growth profile remains resilient, and the sharp repricing in yields that we have seen higher over the past couple of years makes it an attractive asset class, providing stable income and potential for capital appreciation from medium to long-term horizon. If we go to the next slide, we expect the Fed fund rates to peak this year. At the recent FOMC meeting last week, they hiked rate by 25 bips to 5.25% to 5.5% as expected. And the Chairman Powell sounded, I would say, a bit more dovish, stating that policy is still data dependent, and no decisions have been made about the upcoming September FOMC meeting or any meeting after that. But from now till then, there's going to be a fair bit of data. There's going to be 2 more CPI prints, 2 more payroll numbers. So quite a fair bit of data that needs to be evaluated first before any decision can be made. That said, we are close to a peak in rates, and I think what it means for Asian investment grade bonds issuing in US dollars is that yields are looking very attractive compared to the start of last year, due to the sharp repricing of the risk-free rate that we have seen. And not only that, for Asian credits, you're still getting a spread on top of that by investing in credit bonds. Turning to the next slide, China is, I would say, at a different cycle. While most major central banks have been tightening policy, China has already been easing and introducing more stimulus due to lower inflation and also to boost the recovery in the economy. We expect the fiscal and monetary stimulus measures to be positive to its economy, to the economic recovery, which may also provide a positive spillover effect to other Asian economies as well. Turning to the next slide. So just to continue on China, to add, while we have seen the property sector in China come under pressure, the government has been introducing targeted measures to support the sector. That's it. The recovery among issuers, we think, will be uneven. With credit fundamentals of stronger players such as the state-owned enterprise developers, that has a strong presence in the tier 1 and tier 2 cities, to be the likely outperformers. We are generally constructive on the investment grade property issuers, but we remain cautious and highly selective in the high yield issuers. Next slide. So I would say that most major central banks are close to the end of their tightening cycle, such as the Fed, and most recently the ECB hiked rates by 25 bips last week. Lagarde dropped her forward guidance and acknowledged the weaker economic situation. Even the BOJ also announced that they would continue to maintain their accommodative policies, but allow more flexibility on their yield curve control to cater for more volatility if necessary. So closer to home, Singapore. Singapore's growth was above trend at 3.6% last year. That said, Singapore's economic outlook for this year stays challenged as we think downside risks in the global economy remains elevated, which will likely weigh more heavily on Singapore's open economy, such as exports and business investments. That said, Singapore's strong fiscal standing position should also be able to help with economic resilience. Growth for this year is expected to be forecast within probably the lower of the 0.5 to 2.5% range. That said, despite the drawdown on past reserves, Singapore continues to maintain its solid AAA rating by all three external rating agencies with a stable outlook. And this gives comfort to investors as many high-quality Sing dollar issuers they have direct or indirect links to the sovereign, and this really underpins their stability in addition to their strong credit fundamentals. And for us, we do like the high-quality Singapore issuers. The next slide, in terms of the labor market, unemployment rates in Singapore has been dipping to near pre-pandemic levels, and the labor market recovery is expected to remain relatively tight. As a result of tight labor market, resilient domestic economy and services sector should help cushion and support overall growth over here. However, as mentioned earlier, the increased downside risks in the global economy could weigh on Singapore. In terms of inflation, we are also seeing inflation starting to peak and come down, which is consistent to what we are seeing in other developed markets. The next slide shows our Singapore's Sing dollar near. So unlike other major central banks like the Fed, ECB, BOJ, which uses interest rates to manage monetary policy, for Singapore, the MAS manages policy using the currency via the Sing dollar near, and that's because Singapore is a very open economy. So managing the Sing dollar near would be more effective. The MAS went on its most aggressive cycle by tightening policy 5 times since October 2021. But in the recent April meeting this year, they decided to remain status quo. They believe the effects of the past policy tightening are still working through the economy, and this should dampen inflation further. Barring any large upside inflation surprises, it's likely that the MAS will remain on hold for the rest of the year. The next slide, this slide shows the movement in 10-year Singapore government bonds and US Treasury yields. We can see that both move pretty much in line with each other. We have seen a sharp repricing in yields year to date, with yields reaching pre-GFC levels. As I mentioned earlier, we are probably close to the peak in yields, and we think yields are looking attractive at these levels to continue building a longer duration position in a bond portfolio. And then lastly, on this slide shows the Sing dollar corporate bond issuance. We can see that this year issuance has fallen, which is a similar trend with the broader Asian US dollar bond market due to the market volatility. And from an issue point of view, it's more expensive for them as they are generally able to get cheaper cost of funding directly from the banks. However, we will still see issuances, but what it means is that the overall technicals for Sing dollar bonds are better and more favorable for investors.
Okay, great. Thank you, Alvin, and thank you, David, for your comments. I think very interesting insights that you provided on kind of the macro. I think a lot of it, as I share, similar sentiments as well. The Fed really appears to be at least a little dovish on the margin, and with the last week's 25 basis point rate hike, inflation seems to be coming back under control. I think the market sentiment has obviously changed overnight from very bearish these equities into extremely bullish. Market breadth is also expanding. Let's see how that goes. Maybe on to David. It's hopefully a good backdrop for active managers, right? I think there hopefully is a setup for more dispersion across asset classes, across markets for active managers. So maybe in practice, given that outlook, what kind of opportunities are you seeing as an income investor? I know you guys have a tilt to income instruments. So what kind of investments are you guys kind of leaning towards, and what are you avoiding?
Sure. Yeah, I think you teed this up perfectly earlier, Sean, which is, I think one of the things we've heard significantly, or at least we did towards the end of last year, but people are now reassessing, is that draw and that desire for people to move towards either short-term interest rates to cash investments has become very strong, because these are rates that we haven't seen in many people's kind of investing lifetimes. But what we want to do is just balance that picture out to reflect the fact that there is a need to maintain a more diversified portfolio allocation, because that risk of inflation, the need to grow your capital to be a long-term successful income investor is very real and present. And as markets have shown this year, in some of the periods where sentiment can be at its weakest, actually returns can be some of the strongest. So what's shown on the left-hand side here is just looking at that change in the overall income picture, looking at the yields across a range of different asset classes, starting with equities on the left-hand side, where overall dividend yield hasn't moved that significantly, versus where it was in the beginning of January 2022. So comparing it near just over a year ago. But fixed income yields clearly have moved significantly. So they are much more attractive now than where they have been. When you pair that with the view that's been communicated of one where we think we're probably nearing the peak in many rates across a number of different regions, that we think does make the role of fixed income not only, number one, more attractive, but also does also play, we think, a more meaningful role now in portfolios in a source of diversification, given those starting yields are just much higher. But what we're showing on the right-hand side is the reason that we don't think you should forget about equities and other investments. And so what we're doing here is looking at in data going back to 1926. Each line represents over different holding periods. So from holding an asset class for 1 year all the way to holding an asset class for 20 years, what proportion of the time would that asset class have outperformed inflation? And so as you can see, equities have got the strongest long-term track record of outperforming inflation. And generally speaking, even when fixed income yields and things like investment grade credit are high, outside of a recessionary period, equities have a very strong track record of outperforming investment grade and other bonds. And so we don't think a wholesale shift in your risk profile, and notwithstanding the fact that yields are higher, is a good idea in terms of a long-term investment approach. What we've seen on the next page is what we're doing is you think about generating income. We think it's critical to not just generate income on its own, but that you need to do that alongside generating growth. And in thinking about how to do that, there's two key decisions an income investor really needs to make in our mind. The first is the relative balance of income sources. Sean, you did a great job of laying out those major sources, which typically are bond yields, equity dividends, and then one alternative source that we look to use, which is premiums from writing covered calls. So number one, what are the relative mix of those sources of income that an investor can combine? And then secondly, choosing investments within each of those categories which align for potential return and income opportunities whilst mitigating the risks of investing in each one of those asset classes. And that relative mix is one of the biggest drivers, we think, of the long-term returns and income generating capability of the portfolio. And what we've shown here is by taking a balanced approach, we just illustrated this with a balanced income portfolio. What we've shown is the 3-year historical returns, comparing that to the risk-adjusted yield. So how much yield you're able to generate for the volatility of that mixed portfolio. And so what this shows is in periods, especially like we're going through at the moment, where ultra loose monetary policy is being unwound, where growth is slowing, exposure to single asset classes often come with unexpected and sometimes expected risks and can reduce the overall income that you can generate and increase the volatility. Whereas taking a more diversified approach can help to, whilst you still generate a strong income, can help to iron out some of those risks and the bumps along the road. So in terms of balancing income, we think doing it in a multi-asset context, especially now that bonds are a great complement to equities, is a very attractive time to be thinking about multi-asset investing, especially when you think about the conundrum of inflation snapping at your heels and making you need to invest, but that risk of recession, meaning that having a core bond allocation to mitigate risk in case we do go into a more severe growth shock, we think is key. So that's the broader context of how we think about putting income together. Let's think about some of the underlying dynamics that you have to be aware of when you're thinking about creating an attractive income portfolio of individual securities. And we'll start by thinking about through the context of the equity side. And so one of the biggest challenges when you focus on selecting companies who generate income is They tend to be companies that are more mature in their industry or their business cycle. Reason being is that if they're paying a strong dividend, that might be because they're not reinvesting as much of those earnings for growth in the company, because there's less attractive opportunities for that growth to grow shareholder value. And so one of the challenges is still investing in companies which have the possibility of generating strong long-term earnings growth while still generating an income from the stocks. And so what you're seeing, and we've shown this on the left-hand side, is you have to be aware of what we call the value trap, which is high dividend approaches to investing in equities can often mean you end up with a value bias in your equities. That means that you might miss out on some of those more growth-orientated companies. And as we show on the right-hand side, in a year like this year, or in a year like 2020, the dispersion between the performance of those stocks, where especially this year, technology, communication services, who have been driving tremendous earnings growth, you can really miss out on some of those market rallies. So make sure if you're investing for income, you have a balanced approach which still allows you to select some of those high growth companies and avoid that trap. When you think about some of the themes, so investing in equities at the moment, as you noted, there's very large dispersion. And even in a period where growth is perhaps a little bit lackluster, we do think there's opportunities if you can identify stocks that align themselves to themes that you think can drive outsized earnings growth and income, that you can still generate very attractive income. And three of the three sort of themes that we're investing in our equity side are: number one, energy independence. So many regions think about greater energy independence, and as they move away from reliance on Russian oil, we're looking for companies that have benefit from both that move to green technology solutions, as well as sourcing and generating energy earnings outside of Russia across other regions. Secondly, inflation beneficiaries. So as we hopefully communicated, we do think that inflation is broad-based. It's across a number of different categories. There are certain companies, for example, real estate, not commercial real estate companies, but companies, for example, that are involved in things like data centers. You've seen a move towards what we call re-onshoring, so people moving their supply chains back to domestic, and you can buy companies that have inflation linkages in their contracts, and so you can generate very strong earnings on that side. Equally, consumers, as they run out of and they run down their savings, we think you need to be quite cautious about some of the more cyclical consumer discretionary areas. And so we're running very selective names for beneficiaries who perhaps will benefit from consumers moving down in quality, from being more frugal. We think there's still some opportunities within consumer discretionary for generating strong income and returns. On the next page, thinking about the credit side, so as we provided an outlook at the moment, credit fundamentals still look quite strong in many respects. The very cheap financing rates that have been available for the last half a decade, many companies have used that to extend the maturity of their debt. And so you've seen, as a result of that and continued strong earnings, you've seen default rates on lower rated bonds remaining very, very constrained. We don't think there's going to be a huge dump in default rates, but as we show on this chart here, what we're showing is the spread, so the level of compensation or the level of yields above treasuries that are being paid for both investment grade corporates and high yield corporates. And as you'll see in the two black areas, when you're in periods of recession, that spread risk can jump very, very quickly. And so you need to be conscious of the overall level of prevailing yields that you're buying bonds at. For us at the moment, we are starting to move up in quality. We're doing that in two ways. We're moving up in the credit spectrum, buying more investment grade bonds. And secondly, we're looking for companies which are in less cyclical businesses who perhaps won't be as exposed to a growth slowdown. Just two other charts, and then I'll hand back to you. On the next page, page 14, is, it was a very challenging year for emerging market debt last year. The impact of Russia-Ukraine crisis led to a big sell-off in emerging market debt bonds. Equally, the faster hiking from central banks in emerging markets led to underperformance of many emerging market bonds. We think now there are some very attractive opportunities. What we're showing here is the height of the bar reflects what we're thinking of the yield of a portfolio of a certain asset class divided by its risk. And you can see that especially EM corporate bonds, EM local bonds, and EM and sovereign bonds, all on a risk to yield basis, we think actually look quite attractive now, especially in an environment where you could start to see the rates in some of these emerging markets coming down. And so we think emerging market debt is actually a very attractive part of an overall portfolio at the moment to complement developed markets. And lastly, but not least, covered calls. So covered calls are essentially a really helpful tool within a broad diversified portfolio. Typically, to generate income, especially in credit markets, you have to take on more downside risk, the risk of a bond defaulting, a corporate not paying back their debt. And by writing covered calls, you essentially are, giving away some of the potential upside participation in equity markets to generate an incremental income. And what we're showing on the left-hand side is we've taken 4 of the major equity markets. The black bar shows you what the dividend yield you can generate by investing in those markets are, looking back over the last 10 years. And what we've shown is on top of that, if you write covered calls, what we think is a reasonable option premium yield that you can generate on top of those to generate a holistic income from your equity portfolio. And in a period that we think we're in at the moment, which we're going to define as a fat and flat market, so one where markets are moving very broadly, volatility and or at least the expectation of volatility has remained very high. And that sort of environment where equities aren't moving out significantly on the upside or downside, writing covered calls and generating an income, we think is a very attractive source of incremental total returns and income opportunity for an investor portfolio.
Thank you, David. Very, very helpful to kind of learn where some of the opportunities and where your portfolio is leaning towards. There was actually a question that came through, which will tee Alvin up perfectly. I think if you could weave it into your comments, really, the broad one is, is Asia fixed income still very relevant? There was a question here about Asia bonds versus global bonds, right? Where are spreads today? Is that very attractive? Specifically, Asia IG versus US IG. I think if you could weave that into your comments, that would be great. Thank you.
Yeah, thanks, Sean. And actually, all these are really good questions, and all these are going to be in some of the slides that I'm going to talk about later. So, as just to address the first question, if I'm not mistaken, is why Asia bonds? What developed proposition? So I would say that 2 decades after the Asian financial crisis, Asian economies have thrived. They are benefiting from better regulatory and capital market reforms that have boosted the region's competitiveness. Asia is now the world's fastest growing region, and thanks to these strong fundamentals, Asian bond markets are becoming deeper and more diverse, as well as boasting attractive yields and low volatility. And Asian bond markets tend to exhibit lower correlations compared to developed markets and provide diversification benefits for investment portfolio. Over to the next slide. If you look at the Asian bond market, the Asian bond market has been growing at a very rapid pace. It's growing at around 16% annually over the past 5 years, and it's expected to grow even faster going forward. So even after stripping out Japan, the Asian bond universe is still bigger than the combined size of developed countries such as Germany, France, UK, and Japan. In addition, the IMF forecasts Asia to contribute around 60 to 70% of global economic growth, whilst Asia is underrepresented with a weight of around 7 to 20% of global bond indices. The next chart shows GDP growth on a year-over-year basis for the major countries and the different regions over the past 10 years. From this chart, we can see that Asia, excluding Japan, has been growing much faster on an average between 5 to 7%. And even in 2020, during the COVID period, Asia still managed to eke out positive growth while the rest of the world was contractionary. And for forecast for this year and next year, Asia's growth is still expected to be well ahead compared to other regions. As such, we can see that Asia is expected to remain the one bright spot within the global economy, and there's many potential growth opportunities within the Asian region. The next slide, this chart shows the sovereign credit ratings of the different countries. There's a wide dispersion in credit ratings for Asian bonds, ranging from AAA to BB. So starting from the highest quality, and that's us, Singapore, which is rated AAA by all the 3 external rating agencies, which is S&P, Moody's, and Fitch. We are the only country in Asia that has this gold standard, and one of the 9 countries globally to be AAA rated by all the rating agencies. We are generally seeing an uptrend in credit ratings in other Asian countries as well. And that's because, these countries have been implementing meaningful structural reforms, improving their foreign reserves, and, they also tend to have, more favorable demographic dynamics. And these are some of the positive factors making them higher quality in the eyes of the rating agencies. Over the next slide, ever since the Asian financial crisis in the late 1990s, many Asian countries have taken the necessary steps to be prudent when it comes to spending and also to increase the FX reserves. On this chart, we can see the FX reserves for Asia, excluding Japan, has been steadily increasing over the past decade. China's FX reserves constitutes slightly more than half, coming in at around 3 trillion. And the rest are spread across the different Asian countries such as Singapore, Korea, Malaysia, Thailand, etc. The total FX reserves in Asia is significantly more than other emerging markets like LATAM and emerging Europe and Middle East combined together. And these considerable FX reserves acts as a buffer against any future crisis. The next slide shows the nominal and real 10-year government bond yields. Not surprisingly, most European and developed economies are experiencing high inflation and negative real yields, whereas most Asian countries are experiencing higher nominal yields in a more well-behaved inflationary environment, so resulting in positive real yields, which puts our region in an attractive spot. Now, I think over the next slide. So this slide really addresses one of the questions, comparing Asia corporate bond yields with similar rated US corporate bond yields. So the left chart shows investment grade credits, while the right shows high yield. The green line shows the yield for Asia credits, while the blue line below shows the yield for similar rated US credits. And the shaded area shows the additional yield pickup, or I would say spread, that you get between Asia and US corporate bonds. And from these charts, you can see there's still an attractive spread pickup by investing in Asian credits compared to US credits. The next slide, this slide shows the new supply in Asian US dollar bonds. The left chart shows the new supply of Asian US dollar bonds spanning more than 10 years and how it's being allocated to different regions. As shown, allocation to Asia, as shown by the green shaded box, has been increasing and represents almost 3/4 of the total allocation. The breakdown on the right by investor type shows that more than half of these new issuances are also allocated to real money investors such as asset managers, insurance and pension funds, which tends to be sticky and have a longer time horizon. So what this means is that the technicals for Asian dollar bonds are generally more supportive due to the large and stable regional investor base, and relatively more resilient to external shocks and capital outflows than in the past. So, besides having a strong Asian bid that provides an anchor, Asian US dollar bonds also enjoy better volatility adjusted returns than many of their EM counterparts if we look at, at a 10-year horizon. If we go to the next slide, this slide shows Asian bonds risk adjusted returns versus other asset classes over the past decade. How should we read the chart on the left? The x-axis shows risk as measured in terms of standard deviation, while the y-axis shows the returns. So you want asset class to be located further to the left and higher up the chart, and that's where you have lower risk and a higher return, and we can generally see that Asian bonds are located in that area. The next slide shows the performance of ESG bonds versus traditional Asia bonds. So interestingly, years ago we seem to get the question, or there's a general perception that incorporating ESG into the investment process would mean sacrificing returns. That's it. We like to show you that we do not give up performance if we incorporate ESG in an investment process. ESG is the consideration of environmental, social, and governance factors alongside traditional investment management. And the left chart shows the JP Morgan Asia Credit Index, which is Asian US dollar bonds versus the newly created ESG Jackie Index, which is a subset of the Jackie taking account of ESG risk. And we can clearly see that over the past decade, the ESG Jackie Index performs broadly in line with the Jackie Index. And on the right-hand side is the carbon intensity of the indices. Carbon intensity is the tons of CO2 equivalent per $1 billion of revenue. What we have done is we have taken the corporate bond component of the Jackie on the far right, represented by the orange bar. We can see it's quite a high carbon intense index. So the Jackie Index, GHG intensity is about 480. With the JESG Index, the outcome has greatly improved. That's about 68% of the carbon intensity compared to the traditional Jackie Index. But in terms of performance, if you look on the left, it's pretty much similar. So by incorporating ESG in the investment process, not only can you have the same stock returns as the traditional index, but you also have a way lower carbon footprint in your portfolio. So just to summarize on the last slide, Asian US dollar bonds, provide an opportunity for investors to be invested in a fast-growing market within the region. So investors looking to earn returns on excess cash, primarily chosen bank deposits to escape market volatility. Moving forward, we believe that changes in the macro landscape, particularly a Fed pause with the sharp backup in yields, and Asia underpinned by solid fundamentals as well as attractive valuations, mean that a diversified portfolio of Asian US dollar and Sing dollar bonds can provide investors with strong income generation and potential for capital appreciation upside over the long term when rates gradually move lower. And coupled with a lower volatility profile, we believe investors should pay greater attention to the benefits of this asset class in this current market environment.
Okay, great. Thank you, Alvin. So I'll just round it up in terms of, I think a bit of accessing some of these funds on FundSmart. I think a lot of people kind of look at it, they're very excited and they don't know how to proceed from here. So really, when we think about the 11-person investment office at Endowus and what we focus on, I'm part of this effort. We really look at curation of best-in-class funds to cover every asset class. And these are, obviously long-only portfolios and funds. So, you can just go on the website very easily and just screen for funds available from Goldman Sachs Asset Management. Those are on the left. The fund in which David is a part of, he's a portfolio manager there, is the Global Multi-Asset Income Portfolio. And then on the right, if you do a filter for Manulife Investment Management, Alvin, portfolio manager for SGD Income. And obviously we have a very, very high quality preferred securities income fund from Manulife on platform as well. So again, if you have any questions about the platform, just reach out to our client advisor team. They'll be happy to help you. FundSmart, really, just a minute here on what we do. So we really kind of curate best-in-class managers. We have an open architecture platform. We work with 40 or 50 plus global fund managers as we're launching more alternatives. That list is growing as well. Other fund platforms really don't do the curation that we do. We really try and find, best-in-class funds for every asset class. So you want to cover the whole spectrum, but you really only want to offer funds that completely make sense. And when you do that, you also offer it a very, very low fee. We're completely transparent. We do not charge upfront fees. We pass back any trailer fee rebates directly to clients. So you'll completely see, what we're charging you. It's completely transparent and it's a very low all-in fee. So again, we've highlighted some granularity on the right. I won't go through it in the interest of time. Finally, this is just an example of the fee savings, but I think it's very simple to see on the left. Endowus, the all-in fees are very, very attractive versus, if you were to go to another platform to buy, it would be multiple times more expensive. So with that, maybe just, I'll pose a very, very quick Q&A. So the first one that came through while you were speaking, Alvin, was, I think it's a question for both of you, but maybe Alvin, you want to start here. The question here is, interest rates are expected to be higher for longer. Do you expect that to be, 1 or 2 years or more? The example cited here is the Great Moderation lasted for decades. So really, how do you think this cycle of interest rate, if the Fed is watching and they're saying, well, we're really going to wait for inflation to come back down. And if inflation is a bit more sticky, they may continue to hike. At least the rhetoric was last week that they'll continue to hike interest rates as needed, right? So will it be a longer rate hike cycle, or will interest rates stay higher for longer? So maybe Alvin, you want to start, and David, if you have any other additional comments.
Yeah, it's a really good question. I think one thing about when we think about the hiking of interest rates, the transmission mechanism, how long does it take to feed into the economy? It takes about, it's a lag impact. It takes about 12 to 18 months. If you look at the start of last year, that's when we really started the interest rate hiking cycle. And we are coming to, 18 months or 1.5 years into that cycle. So, and we have seen some of the risks, especially in the financial system. I mean, in March, you had bank runs in the US. You had issue on CS, the AT1s blowing up, and all these are really because of it's an effect or impact from the higher interest rate environment. We have not seen this hiking cycle. It's the most aggressive we have seen in 2 decades. So I would say that that we might see potential. I wouldn't say landmines, but I think we are going to have a bumpy ride ahead. There's going to be more volatility, and I think when push comes to shove, when the economy starts to to show signs of distress or cracks, and we do expect that the U.S. economy to potentially to potentially recession is probably pushed back later. It might be a soft landing or whatnot, but it's still going to be much lower to where we were before. And when push comes to shove, as I mentioned again, I think the Fed needs to reassess whether they should continue hiking rates. Our stance is we are probably closer to the end of this tightening cycle. I would say maybe potentially one more rate hike. We still have from now till September, 2 more inflation prints and 2 more job reports that we need to take a look. And I think once we can have a better clarity, we'll probably have a sense that we're probably closer to the end of this tightening cycle.
I think so much as well.
Sure. Okay. Hey, maybe just being very mindful of time. David, one question to you. This one didn't come through, but I think it's quite top of mind for a lot of investors. It's really the question on, the Magnificent Seven, right? There's been very low breath within the U.S. market. Do you guys think about within the equity space, kind of, you mentioned earlier, kind of having that broad, you don't want to miss an opportunity, but at the same time, you want to have that diversification, right? Are you guys kind of looking at, that Magnificent Seven? Are you looking at diversifying out of, large cap tech within the US, or even, because you have the opportunity set that's global and, valuations might be less rich in emerging markets? How is your team thinking about that?
Yeah, of course. Yeah. So that's one of the things that's really, I think, stood us apart this year in terms of overall performance, is that we do have that balanced approach. We think that some of the kind of exuberance and positivity around the potential for AI to drive disproportionate earnings. We don't think it's a tech bubble in the same sense you've seen in kind of previous periods. And we do think that some of this does really have the potential to drive earnings. I think one of the things that's interesting in what you're seeing at the moment is, these are not small companies coming with new technologies. These are some of the, as you mentioned, like the biggest companies out there that are really seeking to drive this change with some proven technology platforms. Yes, there's still a lot to be worked through in terms of the regulatory side of things, about data security, around the use of some of these. But you've already seen practical implementation of this through subscription models for some of these AI tools. And we think not only therefore could it really have an impact on earnings of some of these big tech companies, we think it could have a knock-on impact in the near term to some of the kind of plumbing businesses, so those companies that are involved in microchips and processing and cloud computing. And so within the portfolio, we've made sure that we also have exposure to some of those probably early stage winners who want to be feeding into that supply chain and of AI and that technology development even before it perhaps even gets commercialized from some of these very large companies. So yeah, we don't think now's the time to lean against that trend. We think you need to be very selective about which parts of the kind of investment stack that you're in. But we think being underinvested in the US and tech at the moment would be a bad idea, given US growth is remaining to be very, very resilient, and the margins of these companies and earnings, as we've seen in the recent quarter, have continued to be very strong relative to other sectors, which have struggled a lot more on a year-to-date basis. So yeah, definitely not one that we're looking to underweight yet, but very mindful of just how far they've run this year after a very, very challenging backdrop last year.
That's helpful. Okay, I think we've hit past the hour, so I think we can wrap up the call this evening. So I'd like to thank Alvin and David for joining me, and all the audience for joining us this evening, and obviously our partnership with Goldman and Manulife. So have a good evening, everyone, and thank you very much.
Thanks
so much.
John.